What if your stockbroker's advice is no better than a monkey throwing darts at a newspaper's stock page? Imagine that for a moment. This bold statement challenges everything you thought you knew about investing. It questions the so-called experts and their confident predictions. This provocative idea comes from a famous book, A Random Walk Down Wall Street by Professor Burton Malkiel. His work sent shockwaves through the financial industry, questioning the wisdom of active stock picking. If stock prices move randomly like darts, what does that mean for financial advisors? Are their complex strategies just for show? Could their success be mere luck? It undermines the value of expert picks and suggests a different market truth. So let us delve into this theory, the random walk down Wall Street. Can you truly outsmart the market? Or is there a simpler, wiser path? Let's find out together. The random walk theory is simple. It states past stock prices cannot predict future ones. Each movement up or down is independent, like the unpredictable flip of a fair coin. Today's price change tells you nothing about what tomorrow's change will be. It is a path without a discernible pattern, a truly random journey for prices. Malkiel argues the stock market behaves this way. Patterns you think you see are often illusions. They are not reliable guides for future profits. This directly challenges common investment methods. Technical analysis, studying charts for patterns. Malkiel suggests it might be like astrology. Fundamental analysis, valuing companies. It is also difficult to gain an edge if prices react instantly to new information. These tools lose much of their supposed power. Therefore, trying to time the market becomes very hard. Getting in at the bottom, out at the top, it is likely a fool's errand over time. Picking individual winning stocks consistently? That too becomes more like a lottery. A different way to view investing is needed. Malkiel is a strong believer in market efficiency. What does this mean for you? It means stock prices quickly reflect all known news. Information spreads like wildfire in today's world. Prices adjust almost instantly to incorporate it. There are very few, if any, easy bargains. The market is a swift information processor. This makes it hard to find an edge. There are different levels of this efficiency. Weak form says past prices don't predict future ones. Semi-strong form says all public news is priced in. This includes company reports and economic data. Strong form even suggests private information gets reflected. For most investors, the semi-strong form is key. It means your research is likely already known and already factored into the current stock price. This makes finding an undervalued stock very tricky. If a stock was truly a bargain, many would see it. Their buying would quickly push the price up. The opportunity would vanish in moments. So, the dream of consistently outsmarting everyone? It is a very difficult dream to achieve. Even highly paid professionals struggle with this. They often fail to beat the market averages. Many investors turn to active fund managers. These are professionals who try to beat the market. They select stocks they believe will outperform. They also try to time their buys and sells. This active approach involves higher costs. You pay more in management fees, and trading commissions can add up quickly. These costs eat into your potential returns. The surprising truth, shown by much research: most actively managed funds do not beat the market, especially not over longer periods of time. And certainly not after their higher fees are paid. They might have a good year or two. But consistent outperformance is incredibly rare. This is a central point in Malkiel's argument. The numbers often don't lie on this. Market timing is another tempting but dangerous game. Trying to sell before a crash, or buy just before a big rally? It sounds smart, but it is nearly impossible. Missing just a few of the market's best days? That can severely damage your long-term results. No one has a perfect crystal ball. The market's short-term moves are too unpredictable. Human emotions often get in the way too. Fear can cause panic selling during downturns. This means locking in losses at the worst time. So, if active strategies are so flawed, what is the answer? Malkiel strongly advocates for passive investing. The core idea is to buy and hold, specifically, to own a broad market index fund. This type of fund does not try to pick winners. It simply aims to mirror a market index, like the S&P 500 or a total stock market index. You essentially own a tiny piece of many companies. The benefits of this approach are quite compelling. First, index funds have very low costs, since there is no active manager to pay dearly, or frequent trading to cover. Second, they offer instant diversification. Your investment is spread across many stocks. This reduces the risk from any single company failing. They aim to match market returns, which is often good. A long-term perspective is absolutely crucial here. Investing should not be a sprint. It should be a marathon, run patiently. Consider investing a fixed amount regularly. This is called dollar-cost averaging. It helps you buy more shares when prices are low, and fewer when prices are high. Then, let the power of compounding work its magic. Malkiel's work urges us to consider a simpler truth.